Lawmakers in several states are encouraging elderly residents to sell their life insurance, giving up death benefits, and then use the cash settlements to pay for long-term care. Governor Rick Perry of Texas signed a law last week to let Medicaid officials in that state tell people they can sell their policies to help cover the cost of long-term care. The more private money is used, the less state Medicaid money is spent. Now, there are several bills, similar ones, pending in at least 7 other states. Our guest tonight says he likes the idea. He's Paul Auslander, co-founder and CEO of American Financial Advisors. He's also chairman of the Financial Planning Association, the nation's largest financial planners group. Mr. Auslander, welcome. Good to see you.
Thanks, Tyler. Good to see you.
So under these proposals, what would happen is that you would sell your right or your beneficiary's right to a death benefit to a third party, a settlement company of some sort, but you would take a discount, wouldn't you, on the amount of cash you would receive for giving up that right? And how much would that discount typically be?
Well, that depends. That's right. You defined it properly. The issue, if you keep in mind for a moment, these are people that are running out of money to pay for their long-term care. And so this is something of a last resort, either by themselves or perhaps their children who are helping to pay for their long-term illnesses and are also running out of money to be able to do so. And so the idea of a death benefit is less important to them than the amount that they can get up front. And even though the companies that put this together are extracting a rather healthy fee, the fact is that the money that the client winds up with is something that they desperately need. And so that's something that will probably have to be worked out if those fees are fair. But I think on balance, the idea is good because it helps the consumer get access to cash that they might not normally have had.
Paul, any risks to this strategy? What are any unintended consequences here?
Well, I think the main one, and it goes to the issue of full disclosure, is the client needs to know, the person needs to know that they'll no longer have that death benefit that they're leaving for their family. And so if the children are involved and the parents make these decisions together, I think that's the only downside that I can see. I've seen these situations where I would just recommend that someone pay an independent third party to review this, preferably a certified financial planner that has a fiduciary responsibility to their client to at least do an evaluation to make sure that this is in their best interest. But assuming it passed that test, I don't see a lot of downsides.
So if I have a $100,000 death benefit on, for example, a term life policy, and I want to sell that death benefit to a third party, how much would I be likely to receive?
The numbers, Tyler, are all over the ranch. It's not a formula, and that's one of the areas where I think as this gains more acceptance, you'll see it more regimented in that fashion, but it could be anywhere from $35,000 to $65,000, depending on the company that's doing it.
All right, so a Texas governor is going to sign this into law, presumably. There are a couple of other states looking into this. What is your sense of how many states are going to adopt this? Is this going to become standard operating procedure going forward?
Well, I think it will, and the reason being is all of these states are under the same Medicaid crisis, right? So the big issue for their legislatures and their governors is how do we take some of that expense off the taxpayers of the state and over to the private sector, and this serves that purpose. So I think it's going to do surprisingly well in many states as they look at it. Of course, there may be some legal challenges. The insurance industry probably won't like this on balance, but in general, I think you'll see more and more states accept it. Also, keep in mind that the idea of long-term care insurance has been getting harder and harder to get over the last few years. The big-name companies have frankly exited the business. The large companies that we all know the names of have decided that that business is not profitable. So there are less choices out there, and it's become more expensive. So alternatives have to be selected, and I think this is one of them.
Very, very quickly, if I hold on to that life insurance policy, does that preclude me from getting coverage under Medicaid for these long-term care costs?
Well, that's one of the issues, Tyler. And to your point, that's what these bills are trying to do, in effect, is keep people from dropping those policies to qualify for Medicaid and, in fact, burdening the system more.
All right, Paul, thank you very much. Paul Auslander, co-founder and CEO of American Financial Advisors.